Good afternoon, everybody from Hong Kong. Wish you a very warm welcome. It's Anand Bhattepati, and thank you for all coming here to this event. My hope is that you will find the material we cover insightful and useful in your journey to becoming more successful investors. Some legal notices. GFM is a licensed and regulated investment management firm. This is a purely educational presentation. Nothing, please don't take anything discussed in this presentation here as investment advice or a recommendation to buy, sell, trade any security or other investment asset. This is my background. I started GFM a few years ago after working in London, New York, Hong Kong at various investment banks. Um, as you can see, worked in way too many banks, way too many companies, and hold way too many degrees. So, if you like, my career goes back into sort of three phases. The first phase, I was a corporate finance investment banker, and I ended up being a startup venture capital investor. And to me, that taught me a lot about assessing management teams and spotting who can deliver versus who cannot. Because in an early stage company, you basically have some smart people, um, shorts, t-shirts, and a bright idea with a PowerPoint. My second phase of my career was about living on the trading floor, trading derivatives. And the biggest lesson I learned from that was risk management. How many ways things can go wrong, and how do you control for that? What can you do, and what is outside of your control, and how do you be prepared when these unknown unknowns and known unknowns come to pass? And finally, I started GFM uh, on the same principles as the Buffett Partnership of 1957. What I mean by that is we hold each client's money in separately managed accounts in their own name and ownership at a third party financial institution. And this third party financial institution plays the role of a policeman. They safe keep your assets in your name. They send statements, they do the fee calculations, and they do the trading executions. We cannot touch the money. It turns out to be safer, cheaper, and a lot more tax efficient than investing through a fund from an investor's point of view, from your point of view. It's a bit more work from our side, but we'd rather have this for all our clients than have them invest through a shell company in Cayman Islands. Second, we're performance fee only. In other words, we do not make any money unless the client portfolio significantly appreciates in value and the increase in value is higher than the previous highest level of the portfolio. So, in other words, $100 becomes $200 and we get paid. And let's say the high water mark is now $175 after the fee is paid. The next time we'll accrue a fee, we'll earn a fee, is when the portfolio significantly appreciates well over $175. If it drops to 150, no fee, 125, no fee, comes back to 175, no fee. So it's performance fee only, subject to a high watermark. Third, we are principals alongside our investors. We have the exact same motivations and we carry the same risks. We have a portfolio with our own money, my own money, that is in exactly the same investments as that of our clients. And finally, uh, we are not a jack of all trades. We only do one thing, which is manage investments on behalf of our clients, and performance fee is our only source of income. We carry all operating costs personally, and unlike a fund, and we are aligned 100% exactly the same as our clients. So we invest with the goal of doubling money every 3 to 6 years versus an 8% stock market return over the long term, which translates to roughly about a double every 9, 10 years. So this is the goal of how we invest, and we've done quite well. I'll come back to that later. Ever since we started, we've significantly outperformed the stock market averages. So let's get into the presentation itself. And before I dive into the meat of the presentation, I'd like everybody to understand some of the terms the same way that we intend them to be used. So, first of all, I'd like to just briefly describe what is a drawdown, what is a maximum drawdown. So, on this chart, you see the blue line, and the blue line is approximately a 20-year history of S&P 500. So, if you had put in at the turn of the century, approximately $100,000 in S&P 500 in overall equities. At the end of some 20 years, it would have turned into something like 450K, which is a fantastic result, 4.5 times your money. But along the way, you could see that there were some big declines. Now, what you see in the red line on this chart is the red line tracks the highest value of the market until that point in time. So over here, you see that the market had peaked and then it declined. So the highest value was here, and then the market decline was here. And then after some time, it recovered, then it went to new highs, then it declined, went to new highs, and so on. The red line just tracks the running max. What a drawdown is, if you were unfortunate to buy at the highest price and sell at the lowest price, how much money would you have lost? A drawdown answers that question. You see this yellow line? If you had bought here and you had sold here, you would have approximately lost about 50%. And if you had, let's say, bought here and sold here, you would have lost approximately 20%. Of all these drawdowns, the biggest one was this. So this is a maximum drawdown, which in this period of time, in this 20 something years, is the highest, is the maximum drawdown. And this corresponds with the 2008 crash. That was the global financial crisis. So this is what we mean by a drawdown and a maximum drawdown. And I want to briefly describe what a percentile means. And please humor me for all the engineers and statisticians here. I just want to make sure that everybody in the audience think of these terms as we use them in the presentation in the correct manner. So on the left side, I have monthly stock market returns of the US stock market going back 96 and a half years. So that's so that's 1,146 monthly returns. So some months there were declines, some months there were appreciations, and if you chart these, this is the frequency distribution. So sometimes you saw some big declines. Some months you saw some very big appreciations. Most of the time there was some moderate appreciation or some moderate decline. So the highest return is the maximum. That's the best return. The lowest return is the minimum. The most frequent return, so 50 out of 100 observations, that would be the median return, the most frequent result. And a 20 percentile means if you have 100 returns, then the 20th lowest return, not the worst return, but the 20th lowest return out of 100 returns. And that would be somewhere here. So this is what we mean by percentiles, 80 percentile, 20 percentiles, median, and so on. So, okay, high school is over. Let's get into the meat of the presentation itself. First question: why bother investing or trading? You have some money in your bank, you earned it fair and square. Why do you want to invest, or why do you want to buy a stock in Apple or a bond in some company or an ETF or anything of that sort? Why not just go on a holiday, have a good time, or enjoy your life? The point about investing is you're putting money away that you can otherwise consume today, so that this money can go to work and appreciate into higher wealth for you in the future. It's also about growing your wealth faster than inflation, so that your purchasing power, what you can buy with the money that you have saved and invested for the future, is higher in the future than what you can buy with it today. That's higher purchasing power. So this is basically why anybody trades or invests, in order to improve the quality of your life, improve the amount of financial resources that you have to support your lifestyle or help your family along or whatever. So this is why we put money to work. Otherwise, we'd be much better off consuming it right now. So when we talk about investing, we have various things that you can invest. You can buy a property, you can become a partner in a restaurant, um, you can buy some government bonds, you can buy equities, you can buy an ETF, you can buy mutual funds, hedge funds. The list is nearly endless. So here's nearly 100 years of data, 96 and a half years of the US stock market. And depending on where you had put your money, this is how your wealth would have grown over this 100-year period. So what you see is the gray line here. That is inflation. If in 1929, uh, something would have cost about $100,000, from the effect of inflation, the same thing today would be worth 1.5 million. So what you could afford for $100,000 back 100 years ago, you would have to fork out $1.5 million to buy the same thing nearly 100 years later. So this is the effect of inflation. And when I say you want to increase your purchasing power, you want to do something with your money today so that it grows at a higher rate than inflation, so that you have more money than how much things would cost otherwise. So if you look at the lines here, you would see that this is inflation. The light blue line, these are short-term US Treasury bills. So effectively, over a 100-year period, had you kept reinvesting in 90-day Treasury bills, you'd have just about kept up with inflation, just about maintained your purchasing power. You didn't become fabulously rich. What you could afford back here, you'd be more or less be able to afford the same thing 100 years later. You didn't become richer in purchasing power terms. You can't afford any more than you were able to afford back here. And then if you had put money into various types of bonds, uh, short-term government bonds, the orange line, long-term government bonds, the green line, corporate bonds, the yellow line, your wealth would have appreciated, your purchasing power would have gone up, and 100K after 100 years would have turned into 11 million or 17 million or 28 million, depending on what you ended up being invested in. But look at this is a good result. But it did grow your purchasing power, but look at the opportunity cost. Had you instead stayed invested in equities, the blue line is large cap equities. You can think of this as the S&P 500. Approximately 85% of the market capitalization of the US market at all these different points in time. If you had you invested in large cap equities, $100,000 would have appreciated to a life altering $1.3 billion in 96 and a half years. Well, where is 28 million and where is 1.3 billion? That's, you know, a difference in wealth appreciation in hundreds of times. So that's the power of investing in equities. Now you see the red line. These are small cap equities, the bottom 15-20% of the US stock market. Had you invested in the smallest of these stocks, it would have not appreciated 1.3 billion, but it appreciated to 5.3 billion, nearly 4.5 times more than large cap equities. In fact, the per year, the per annum difference in returns is quite small. Large cap equities appreciated by approximately 8% on average. Small cap equities appreciated by about 10-11%. So the difference is only about 2 or 3% per year. But the power of compounding is such that that 3% increase in the rate of growth of your wealth over a long enough period of time, 100 years in this case, translates into a gigantic difference in end results. You see an empty space here. That's because I don't have the data to populate it. But private equity would be somewhere here, real estate would be somewhere here, and so on. And this, if you like, in one chart, is a 100-year summary of investing in various types of assets in the US market and the impact it would have on your final wealth over a long enough period of time. Now, this is an extreme, 100 years. But 2 points to note. First, the same kind of data and studies are available for various other countries, Japan, Australia, UK, and so on. And the results are comparably the same. The numbers are obviously different, but the pecking order, small cap equities is the best performer over long terms. Overall equities beats every other types of asset class. Bonds beat bills, and bills beat inflate or keep up with inflation. This pecking order is roughly the same across these 20 odd countries where we have 50 to 100 years of data available. So it's the same in every country. That's the first point. Second is someone in the audience is probably looking at this chart and saying, what's the use? I'm going to be dead in 100 years. So how does this translate into anything useful for me to do with my money today so that, I can have a better life in the future? So let's answer that question. So yes, I agree that it is an extremely long period of time. But the point of showing you this 100-year chart was that it gives you the personality of various investment assets. It gives you the sort of the base rates that generally come through with the risk reward of these various investment classes. So, having said that, let's move on to shorter time periods. So, in this 100 years of data, we looked at every possible 5-year period. So, we found 1087 5-year periods. We looked at every possible 10-year period, 1027 10-year periods, and 15-year periods and 20-year periods. The result is the same. The numbers are obviously different, but the pecking order is the same. Government, short-term government bonds, treasury bills in the US case, just about keeps up with inflation. Bonds tend to grow your money a little bit, but a life-altering level of wealth appreciation is generated by investing in equities. Small cap, large cap, equities in general. That's over a, that's over the most frequent result over 1,000 5-year periods. Okay, you extend your time horizon to 10 years. Same thing. But the level of outperformance, it's almost 2 times here versus bonds and large cap equities, and 3 times compared to short term treasury bills. Okay, so again, equities beat everything else. And this is the most frequent result over every possible 10-year period we have in 100 years. 15 years, the outperformance is even higher, and it's the same type of conclusion. This is more than 3 times compared to bonds, and this is some 5 times compared to short term bills. 20 years, outperformance is even more pronounced. So as you increase the investing horizon, the outperformance of equities over every other possible asset class tends to get magnified significantly. Okay, so what's the conclusion? So we should all buy equities and go to sleep. Wake up 5 years later, 10 years later, and you would be rich. Uh, the problem is this: stocks have also posted some of the biggest declines seen. The drawdowns that I talked about earlier, the biggest drawdowns were seen in stocks, equities in general. So you see the blue and red lines. This is the Great Depression. If you had bought at the highest level at the worst point of the Great Depression, you would have evaporated your wealth by 90%, at least in mark to market values. This would have driven lots of people into bankruptcy because maybe they were leveraged, or maybe they didn't have the stomach and they sold here, whatever, and they basically lost a ton of their money, and then they swore never to invest again, or just walked away wounded, pretty badly wounded. This is the equity market decline in the aftermath of the Nifty 50 bubble that was there in the US stock markets in the 60s and 70s. And this is the tech bubble. This is the 2008 financial crash. So you look at the biggest declines that you can see across all these asset classes. The biggest declines have been posted by equities. Well, the other asset classes also have had declines, but they were significantly smaller. So let's take a very quick and closer look. Maximum drawdown, the worst possible drawdown across this 100-year period in every one of these asset classes. Like I said, pointed out, equities had the worst drawdowns. This is the worst drawdown is here, the Great Depression. You would have lost between 80 and 90% of your wealth. The worst drawdown in bonds were, I think, somewhere here in the high inflation era in the US. And that turns out to be a 25% decline in long term bonds, and a shorter amount of decline in short dated government bonds. This is deflation that only happened once here, the Great Depression, when there was deflation. So the worst in equities is always much bigger than in this period was much bigger than the worst declines in other asset classes. So first thing. But what if you forget about the worst possible decline, but you look at the 10th worst decline? The 10th worst decline was somewhere here in this range. In equities, That was between 25 and 50%. In the other asset classes, it was about 15, 20%. The 20th worst drawdown, the 20th percentile drawdown, again, around 25% for equities and much smaller for the other asset classes. So when we invest, we don't know in the future whether we'll see this or this or this. But we invest assuming that our portfolio should remain unshaken and we should be able to hold on without doing something stupid like closing out due to a margin call or losing our stomach and selling out a big loss or something. So when we invest, we prepare our portfolios or we expect to see some point in the future in the next several years a decline between 25 and 50%. And we invest in a way that even if there was a 25 to 50% decline, a 50% decline, we should be able to go to sleep. And we picked our investments this way. We managed our leverage this way. We invest our positions are the positioning of the portfolio and the position sizes are such that they're not going to come and create disaster. So this is what I would say. Over a long enough period of time, equities beats every asset classes. But the problem with equities is that from time to time they see very big declines. And so this scares away people. But the illusion of keeping your money safe, i.e., keeping not seeing mark to market declines in your investment account, that comfort level actually costs you an enormous amount of wealth over time. This is what you kind of have to remember. So, so far, we've kind of demonstrated that equities are a great investment asset class if if you stay invested, but they suffer from these outsized declines from time to time. Is it possible? Let's ask this question: is it possible to capture this wealth appreciation that equities offer, but not suffer from these suffer a permanent loss from these declines that we see from time to time? So maybe one approach should be that we should buy stocks, yes, because they tend to do well over time, but at our investment horizon should be short to get out of the market when these declines happen. Does this work? It'd be great if it works because then we avoid the declines and we capture the upside, right? If that was to work, then problem solved. Everybody should buy equities, wait for a decline, get out, wait again for the market to normalize, get back in. Sort of people call these by various things, but essentially it's one or another form of market timing. But does this work? So let's see. We took the same data and we looked at all possible 1 month periods. We found nearly 1,200 1 month periods. So it's 100 years data, right? There was really no difference. The median result, the most frequent result, there's no difference between the returns posted by equities and any other person asset class. They're so close that it's hard to even tell the difference. So if your investment horizon is 1 month, doesn't matter what you invest in. Chances are you won't really make money. Not talking about any one specific 1 month period. There were periods where there was a 1 month where there was a big decline or a big jump in returns. I'm not talking about that. I'm talking about the most frequent result you can expect if your investment horizon is for 1 month. You keep buying for 1 month, sell at the end of the month, and so on. So if that is your investing approach, then you won't make any money. That's what you see. Okay, so 1 month doesn't work. What if we increase it to 3 months? Again, yeah, equities made a little bit more money than bonds and bills, and so on. But this is nothing to write home about. This is not going to make a difference to your life. Whether it's 100K or 103K after several periods of investing, many, many years of investing, if the most frequent result is roughly the same thing, then you're not going to, you know, be better off by investing here or investing here or picking one asset class over the other or whatever. You'd roughly be at break even. So investing for a short period of time, equity slightly outperform, but this is negligible. 6 months, similar. Some outperformance, but this is not going to change your life. 7K appreciation versus 2K appreciation. 12 months, yeah, a bit more, but again, it's not going to change your life for better or worse. You're just going to do a hell of a lot more work trying to keep rolling over your investment so that you stick to your approach, but the end result is it's not worth it. 1 month, 3 months, 6 months, 12 months, whatever you consider the short term to be, it looks like this. So short term investing does not work. So these are figures, right? 100K turn into 101K, 100K turn into 102K, most frequent result, and so on. That's a 2% over 3 months. So approximately 8% per year. So we tracked all these things and we did a better calculation. So whether you invest on a 1 month basis or a 3 month basis, the annualized returns are roughly comparable. Yes, 13 is different from 17, but they're in the same order of magnitude, similar order of magnitude. So the median result over every possible 1 month period, the annualized return was 17% per annum, and over a 12-month data set over 100 years, the annualized return was 13%. So roughly you expect to make the same amount of money. But this is the problem. There were some 1 month periods where you put in 100K and it turned into 500K. Wow. There were some other 1 month periods where you put in 100K, it almost went to zero. So this is the story of somebody you would have read in the newspaper. Some kid went and bought some Bitcoin and hit the headlines because he's now super rich. So he bought at some price and he sold and he pocketed a hell of a lot of money. But I bet you if he keeps doing it, at some point he'll end up on this side of the distribution where it's game over, more or less. You see this variability here, 300% minus 100%. All you need is 1 minus 100% and it's over. So if you keep investing short term, you are going to end up sooner or later here for sure, but here for even more sure. And this is great, but this will put you out of the game. And this is this most frequent result. That is this blue line. 80% of the time, you are going to be inside these dotted lines. Again, double your money or lose half your money. Double your money, lose half your money. This is what you see. The variability of returns over the short period of time is gigantic. This is what makes it a casino. About 40% of the time, if you do invest for 1 month periods, you would experience a loss. So 4 out of 10 times. And these losses could be big, nearly 100%, and the 20th worst loss is about 25%. Over a 12-month period, 25% of the time, 1 out of 4 times, you'd lose money, and the amount of money you could lose could hurt, materially alter your life for the worse through investing, if you like. That's what you're going to experience if you invest for the short term. And this is what you can extract from market behavior in the past. So it turns out that by investing, what is more important than chasing big wins is to avoid permanent losses. So suppose you put in 100K and you lost half your money. It's now 50K. For you to get back to 100K, you need to double your return. So, you know, you need crazy amounts of returns for you to come back to your starting points. So therefore, avoiding big permanent losses in investing is more important than trying to chase big wins. This is the first lesson. I think Buffett said it the best. He said, rule number one, don't lose money. Rule number two, don't forget rule number one. So this is what he was talking about. Avoid big losses. And when I say loss, there's a lot of confusion. I'm not talking about stock market fluctuations. That's volatility. I'm talking about permanent losses. I'm talking about you buying Wirecard at $150 a share, the company going bankrupt, and that money is gone forever. That is a permanent loss. Or you buy Peloton at $165 at in December 2020, and it's now worth $30, despite all these big jumps you saw in the last couple of days. In fact, I just published an article on LinkedIn that talked about Peloton and what we had seen back in the day and why we stayed away. So I'm talking about avoiding permanent losses, and avoiding big permanent losses is the key to investing success. Okay, so we saw that if we invest for the short term, it doesn't work. What happens if we do invest for the long term? So, does this work? We saw that if you do invest for the long term, you saw some big declines in equities and in other asset classes. And if you stay invested long enough, sooner or later, you're going to see some of these declines in your investment account as well. But what if you do invest for the long time? Does in the end, is this a more successful approach? Does it work? So I showed you this chart earlier. So repeat. Over a 100-year period, the longer your investing horizon, 5 years, 10 years, 15 years, 20 years, you do end up with much higher levels of wealth in equities compared to all other asset classes. The longer the investing horizon, the higher the wealth appreciation. Number one. This is the most frequent result. This is not some abnormally good period where something happened. This is the most frequent result, the middle of the distribution, if you like. The longer you invest, equities generate a higher level of wealth appreciation. Okay. So on an annualized basis, whether you take 1 month, 3 months, 6 months, 12 months, or long period of time, again, the expected return, the sort of the median return, the most frequent return is similar order of magnitude. So for 12 months, it's 13%. For 20 years, it's 11%. There's, on a per year basis, there's very little difference. But why is this then creating this huge levels of wealth appreciation if the returns are the same or comparable? It is because this casino that we saw disappears as you invest for long periods of time. This is volatility, this yellow and red, the roll of the dice, if you like, on a daily basis. As you invest for long periods of time, the casino disappears and you get a more certain result. You see, the range here is tiny. So, what is happening is as you invest for the short term, you could end up anywhere here. This is fantastic. This means you're bankrupt. But as you invest for long periods of time, stay invested for long periods of time, the range of outcomes shrinks and you're more likely to end up right in the middle of the curve. And the middle of the curve is not bad, 11% a year. Over 10 years, that's, well, it will take you approximately 6 something years for you to double your money if you say invested at 11% return. And because of that, as your investing horizon goes up, the effect of compounding becomes more pronounced. And that's why you see your money making profits and the profits making more profits and the overall levels of wealth accelerating. And this is why the outperformance comes. That's because the casino disappears and you now see the effect of compounding more than you see the effect of volatility. This is an insight worth remembering for the next 50 years. As you invest for longer horizons, you get a more certain result because the effect of volatility dampens away to nothing over a long enough period of time. So we talked about frequency of losses. So in a 100-year period, every possible 20-year period, there was really no period where you suffered a loss, where your money went to nothing or money depreciated. There were the smallest results were still profits. But over here, 1 out of 4 times or 4 out of 10 times, you lost either some or a lot of money when you invested short term. And you can see the pecking order pretty steady. So as you invest for longer periods of time, the chance that you lose money drops significantly. And the amount of money, should you end up in a loss making situation, the amount of money you actually lose, the dollar value, that shrinks. So it's turning into a winner's game as you increase your investment horizon. And that happens because the effect of volatility, like I pointed out, the casino disappears and you get a more certain result. So these are the dotted lines here are volatility. And as you can see, when your investing horizon is short, what you see in your investment account is just volatility. The dotted lines show you that these are very high. But as you invest for long periods of time, the level of volatility that you experience actually drops a lot and goes flat at some point. So volatility itself dampens down with longer the investment horizon. And this happens because, well, let's say this is the daily monthly price fluctuations of S&P 500. So if you invested for a 1 month period, you invested here, you were very lucky. You got like a huge return. Great. You were very unlucky. You lost a hell of a lot of money. Made a lot of money, lost a lot of money. Made a lot of money, lost a lot of money. So this is the casino. But as you invest for long periods of time, this may happen, but they tend to cancel out. You can see that they tend to cancel out. The big move up, big move down. They cancel out. And over a period of time, that tends to drop the effect of realized volatility in your portfolio down. So, this might take some people some amount of processing to get to the bottom of it and truly understand it. But basically, what's happening is as your investment horizon goes up, the effect of volatility cancels out, and what you see is the drift. So, let's say if you have an investment that that does very well, uh, you know, as your investing horizon goes up, the effect of volatility when it's short, the effect of volatility overwhelms the drift, the natural run rate of the asset. That's why you see big jumps up and down. But as your investment horizon goes up, the drift or the run rate of the asset is much more pronounced than the effect of volatility. And as your investing horizon goes up 20 years, effect of volatility hardly matters. So you can see that the proportion importance of volatility kind of drops, and what you then see is what you tend to see the emergence. What you notice in your investment account is the rate of appreciation of the underlying assets innate return generation ability. I It'll take me another 20 minutes to explain this in detail, so I'll just leave it here. We can come back to this in Q&A if required. But I just wanted to show in this chart that as your investment horizon goes up, the effect of volatility drops. That's because volatility scales with the square root of time, and the effect of returns magnifies because returns scale with time. And we looked at the data that we have and we worked out what is the amount of period, what is the time required for the effect of returns to dominate the effect of volatility. And unsurprisingly, equities, you need a longer horizon to see the returns. And for treasury bills, because volatility is so low, you don't need any significant amount of time to see the returns. This is why this is like a tortoise that keeps going, but it doesn't end up very far. And this is a wild horse that jumps around a lot, but ends up with a lot of wealth appreciation. So this is what the calculations here applied on the data show you. If you can't invest for 2-3 years, then don't buy equities. You can't stay invested in 2-3 years, don't buy equities because you won't see the returns. You may sell out a loss, you get panicked, whatever. But if you're investing horizon and you have the stomach to stay there for 3, 4, 5 years, then equities are good because then you start building the wealth appreciation effects of equities. So far we've been talking about equities, the overall personality of stock markets, if you like, or bond markets, if you like. We'll be talking about asset classes. But we at GFM don't buy ETFs. We don't buy index funds. We buy individual stocks. And what I would like to show you now is that if your investing horizon is long enough, provided it is long enough, number one, equities are a great investment assets. But if you know what you're doing, investing in specific single stocks, thinking of them as buying ownership of a company and keeping it for the long term, that can be 50 times more powerful, 100 times more powerful. This is what I'd like to show you now. Not only equities is a great asset class for the long period of time, but individual stocks can be even better investments than overall markets, provided you know what you're doing. So, so in the data that we have, here's the last snapshot, a 5-year period that ends middle of last year. So if you had put 100K in June 2016, 5 years later, your 100K in large cap stocks would have doubled to 225, almost doubled to 196. Well, this one snapshot. Over 100 years, this would have appreciated. But in this one snapshot of this one 5-year period, 100K would have turned into 225K in equities and so on. Okay. This is the best performing asset class out of everything here, right? So let's see how it actually evolved. This is the final outcome. 5 years later, 2016, you put in 100K, and 2021, it was 225K. Best result out of all the other asset classes. So this was the final result. And this is what it looked like over that 5-year period. So it started at 100, had a small appreciation decline, then it went up, there was another decline, appreciation, decline, blah, blah. And it doubled into 225K. And that works out to an 18% return per year, which is phenomenal. It is actually double the long-term average. Okay, great period to be invested in equities. And this 5-year period Buying S&P 500 would have more than doubled your money. Great. But you know, S&P 500 is 80% of the US stock market, right? It's got 500 stocks in it. It's as if you're going out, taking your $100, splitting it into 500 portions and buying 500 different stocks with it. That's what it means if you were to go buy an SPY, S&P 500 tracker. Well, those 500 stocks collectively did very well, but individually there were 500 stocks. So we took the 10 biggest stocks and said, in the same period, what happened to those 10 stocks? Uh, this is what happened. The thick line in the middle is 100 going to 225. That is this. These are the 10 of the biggest stocks in S&P 500. And these are all familiar names: Exxon, Apple, Microsoft, Chevron, Google, Berkshire, Procter and Gamble, and so on. So you can see there were some big winners and there were some big losers. And this happens every single time. Kind of has to happen. If you take a group and put them away, some point in the future, they are going to see some winners and losers. Um, that's inevitable. So let's see. The the two biggest stocks. These are the top 10 stocks. The most important in the biggest by market value and the biggest components of S&P 500. The top two, the biggest and the second biggest, were these two: Apple and ExxonMobil. The yellow is Apple. 100K in Apple would have grown to some 450K. That's twice what the stock market did. This was only 225, only 225K. This was double that. 100 returned 400 million, or four and a half, half a million dollars. Okay. The red, this one, ExxonMobil, 100K would have lost half your money, become something like 60K. But somewhere along the line, you would have lost, that 100K would have shrunk to some 40K. This is a sleepless 5-year journey. Ulcer inducing, heart attack creating, should have. So now, here's the question: was it possible back here in 2016 to know that Apple is a better investment than ExxonMobil? These were the two biggest stocks in S&P 500. So if you can answer this question, you can kind of try and avoid this side of the distribution and stay on the profitable side of the distribution. And if you do that, your investment outcome is 225K, 450K. Huge difference in wealth in only exceptionally strong period of equities, for equities. So, well, back in 2016, to know that Apple was a better investment than ExxonMobil, you already know the result. But let's say we go back here and see, you know, is it, would you have picked, or what would you have investing in Apple and avoiding investing in Exxon? Was it possible? So you're in 2016. So at this point in time, and you are answering this question: which of these two investments will you put your money in? You would put, like I said, if you invest for a long enough period of time, volatility becomes less important to your investment results. And what matters is the return potential of the investment you make. Let's see if we can figure this out. So in 2016, what you'd have seen is this is what both businesses look like: net margin. So that's the amount of earnings the company makes for every dollar of revenue. So in the case of Apple, over the last 5 years, it kept 25 cents in profits for every dollar of revenue that came through the door. In the case of ExxonMobil, it's a commodity business. It sells oil and oil refined products, kerosene and chemicals and so on. It's a commodity, so they can't really charge whatever price they want. The market sets the price. So their profit margin, they only managed to keep 8 cents for every dollar of revenue that walked through the door. So Apple was 3 times more profitable. Then, if you look at this, we call this efficiency. It's how much of revenues can you generate for $1 of equity capital that's supporting your business. That's the ability of the business to take the capital it has, equity capital, and transform that into revenues. So in the case of Apple, for every dollar of equity, it was generating approximately $1.5 to $2 in revenue. In the case of ExxonMobil, things were getting quite tough. There was a great period here where for every dollar of capital, it was generating $3 of revenue, but steadily the markets became tougher and its big business became tougher. And for every dollar of capital, it was generating less and less and less. So the combined effect of this is what people call return of equity. This is margin. This is efficiency. So the combined effect, return on equity, night and day difference. Return on equity is how much money did you pocket in profits for every $1 of equity. You can see that Apple was high and stable. For every dollar of equity, it was pocketing after everything 25 cents. That's a phenomenal business, twice more profitable than the global average. The return on equity for MSCI World or S&P 500, the global average, if you like, is somewhere like 12%, sometimes 10, sometimes 12, in that range. Here was Apple, twice as profitable. That's something else. You can have a company that, you know, on a stroke of luck, 1 year does great profits, but Apple was doing it consistently. That indicates it's a special business. We all know that Apple is a household name, but here the numbers are showing you evidence that it is indeed twice more profitable and therefore a very special business compared to basically the global average, compared to every other company in the world on average. ExxonMobil was initially almost as profitable as the global average and then became less and less profitable. And between the two, you can see this is night and day difference, a difference of 2 to 3 times in profitability. So clearly, which is a better business? It's clearly Apple, not ExxonMobil. Is this a good business? Apple is not a good business, it's a great business, twice as profitable as 2,000 other stocks in the world on average. Okay, so Apple was very profitable, but they were also growing the business. And only way you can grow the business is by reinvesting back in the business. Apple was taking about a seventh of the profits it was making and putting it back into the business to come up with new product services, to go into new product areas. And in this period, they were basically growing their services business, iPod, AirPods, Apple Music, iCloud, things of that kind. So it was reinvesting back into the business, and it was doing at a pretty selective rate. This is actually pretty low compared to the global average. ExxonMobil was also doing the right thing. you saw that its business was getting tough and its profitability was sort of struggling. And so what it did was it conserved capital. So it didn't reinvest back in the business, possibly because they didn't see any good ways of improving a change here or a change here. So they conserved their firepower by not reinvesting. So they mostly didn't reinvest. Whether you take the previous 3 years or previous 5 years, they didn't really take the money that they made, the profits they earned, and put it back in the business. They didn't do that. So that's actually a sign of good management. But anyway, in the snapshot here is Apple was profitable and it was selectively reinvesting back in the business in order to fuel future growth. And these reinvestments for Apple were spectacularly profitable. You saw that return on equity for Apple was in the 20% range, 20, 25, whatever. But the new investments, this capital, was being put in stuff that was, you know, 5, 30 times more profitable, 5, 10 times more profitable than its overall business. This is great because this means that future profits are going to actually, this will actually go step up here when these become big enough businesses. That's a great sign for the future of the business. So in the case of Apple, it's basically signaling that future is going to be better than the past. Well, in the case of ExxonMobil, it was reinvesting something, but it was struggling to turn a profit on these fresh investments. So its overall level of profitability was struggling. It went from like a 9-10% level to a 6-8% level. Operations were getting more difficult. Margins were kind of flat but slightly declining. And it did what it could by conserving capital. But this kind of shows that whatever they did reinvest wasn't working at all. So this means future for ExxonMobil is pretty bad in terms of earnings and revenues and revenue growth and profitability in the future. So this is what you'd have seen back in 2016 before you made the investment. So, and if you go back and you look at these reinvestments that Apple had made in prior periods, you'd see that that fueled earnings and revenue growth and earnings growth, and same with Exxon. And you can see that this is the effect, this is the cause. If you reinvest and you do a good job, then it will fuel growth. And you see growth, the effect of this reinvestment in the form of revenue growth and earnings growth. So in the case of Apple, you would see that, yes, no, they were investing, the investments were successful, and that was fueling top line growth and bottom line growth. ExxonMobil, as we discussed, was struggling to keep its existing business profitable, efficient, and its new investments were not working out. As a result, its growth was anemic and its earnings were struggling. Earnings growth was struggling. So night and day. Cash generation. So despite Apple being so profitable and despite reinvesting back in the business, it was keeping 30 cents of every dollar of cash, every dollar of revenue that was walking through the door. This is spectacular. Makes it a very, very special business. It's not a fluke. This is very hard to achieve, and it was doing it. And ExxonMobil had to support its existing business. It was not making fresh investments, but it's an asset heavy business. You have refineries and logistics systems and so on. So these things fall apart and you have to be replaced and so on. So that consumes cash. So their ability to retain cash for every dollar of revenue after making maintenance expenses and other capital expenditures was pretty low. So again, night and day difference. So Apple, more profitable, reinvesting. Reinvestments are super successful. All that is fueling earnings growth and revenue growth. That generates cash and it was able to keep most of its cash, a third of the revenues in the form of cash in the bank account. This is why it was ballooning. So you could clearly see that Apple was a much better business than ExxonMobil. And this is a summary. Two times more profitable than global stocks. It was reinvesting back. Exceptional triple digit ROE on these fresh investments. And this was very visible in the form of revenue growth and earnings growth. And these numbers are off the charts. And the quality of earnings were very good because those earnings were translating into cash. So what you can see is you're going to see that not only is in 2016 Apple was a good business, but its future looks bright, and therefore the stock should eventually do well. That's what you would expect. ExxonMobil in 2016, its ability to run operations was deteriorating, the efficiency ratio we looked at. And the management was doing what it could by conserving capital. These small percentage of investments, in dollar figures, it would have been big, but these incremental investments were struggling, and struggling profitabilities combined with negative fresh investments was dragging down the overall profitability. And this was manifesting itself in the form of falling earnings growth and falling revenue growth. Its ability to retain cash from the revenues that walked through the door was low and it was kind of declining. So tough. The picture is, the summary is that Exxon is going to have a tough future in the next few years. So you could expect the stock to struggle. So short version, Apple, yeah, the return potential is very good. ExxonMobil, return potential, poor. And as we said, over a long period of time, if your investment horizon is long enough, this is what you end up seeing in your investment result, and this goes away. And this is what happened. Over this 5-year period, stock market did pretty well, but Apple did twice as better than the stock market. And ExxonMobil struggled, had particularly bad times, lost a ton of your investment value, recovered somewhat, but on that 5-year period, you'll be still underwater. You'll be better off buying just the S&P 500. So this is why people say if you know what you're doing, you should pick stocks. If you don't, you should just buy the index. So what we do all day long is we try to 15 investments that put us on this side of the distribution, the winners section, and we do whatever we can to avoid being on the loser distribution. If we are, let's say, two-thirds right and we end up here two-thirds of the time, our overall results is going to beat the market. And this is why we've now outperformed the market since our inception, about 5.5 years ago. So anyway, coming back to Apple and ExxonMobil. So you invested in 2016, but you don't go to sleep. You try and monitor your investments to see what's going on. So the same metrics, profitability over the next 5 years, Apple return on equity was 25%. It was like we saw earlier, but it went up, became even more profitable. ExxonMobil not only was struggling, but then at some point posted negative profits. Cash generation, high and steady. Variable and struggling, negative. Growth, great for Apple, recovering somewhat, but overall too hard to call. But definitely a mixed picture, if not a negative picture. Leverage, bad news. Business was getting tough, but the level of debt they were carrying jumped. So somewhere here is when you saw those big declines. This here, that's because of this and this and this. Um, okay, so after you made the investments, the same metrics would help you, give you a compass to monitor your investment to see if they're on the right track. And the result, this in the end was not a surprise. So I've actually written an article a bit more in detail that maybe you would find useful if you were to read it. That's the link to the article, and it's on my LinkedIn. You can go and look it up. I think it'll give you a pretty good framework of how to think about investing for the long term. And as we've shown you with the data that we have for the last 100 years, that investing long term in equities and then being able to make the right type of investments in equities is a ticket to building a life altering level of wealth. So, having said that, Apple versus ExxonMobil. Apple was a compounder, high return on equity, high levels of, well, moderate levels of reinvestments, which was very profitable. This dynamic created earnings growth, and the quality of these earnings were good, as you see from the cash generation. So that makes it a compounder. And then if you did not overpay, this refers to what you paid. If this was 200 times earnings, there would be no margin of safety. If it was 15 times earnings, which it was, there was some margin of safety because you're paying market prices for a three times, two times more superior business. Well, margin of safety refers to what you pay and the prospect where the risk of permanent loss is low. It was low because the business was healthy and getting stronger. And the valuation was not so elevated that things just normalizing would make you lose money, which was the case with Peloton. I can refer you back to that LinkedIn article. Upside better than downside. Overall risk reward was very good, and that makes it a great investment, which Apple was in 2016. So this is what we look for when we do our work. It takes us approximately 2 or 3 years before we buy a single stock. And that's because we are trying to really get into the skin of the business and then making sure that we do not overpay. This is how we invest, and I hope it helped you as well. I talked about, if you are in a ability to, if you have the framework and the time and the skill set to end up on this side of the distribution of stocks returns and avoid this side, then you'll do exceptionally well. And this is what we do all day long. And we have a long term investment focus. So we have beaten the market pretty significantly. I unfortunately can't put numbers here because that would get us into trouble with our regulator. But if you want to know, you can always send me a private message or an email, and I'll be happy to share the numbers with you. So I said we invest with the goal of doubling money every 3 to 6 years, and we've achieved that. The stock market doubles every 10 years or so. We have been doubling every 3.5 years, pretty close to the 3 year upper limit that we set for ourselves. So this has been our result, and even recent performance has been pretty good. We are looking forward to the next several months because this location is our friend. With that, I wish you all a lifetime of very successful investing. And these are my contacts. Please feel free to drop me a line, send me a message, just say hello. There's no pressure or expectation that if you say hello, you become a client. No, I'm happy to make an acquaintance, start a relationship, get to know each other a bit better.